Good morning, everybody. First of all, I didn't plan to be joining you via Zoom today. I plan to be in class like you all are. However, I got called for some grandma duty because I have a 6-year-old grandson who got sick at school yesterday and still not better today. And so I'm it. So I've got him plugged into some movie out in the living room while I try and teach class. So we'll see how this goes. If suddenly my door bursts open and there's someone vomiting, don't panic. I'll try to turn my camera off. So anyway, that tells you how my morning is. I'll have a few announcements and things at the end of the class and a few things that we need to talk about. But certainly to be respectful of his time, I'd like to thank Dave Eskenazy for making the time to come and talk to us today. And Dave is the CEO of Cogir, and I've known Dave for a long time. I will let Dave tell you his story and his background because it's really quite interesting, especially in comparison to some of the ones that you've heard. But Dave is going to talk to us, try to break down the whole piece about financial management. And as I pointed out in the announcements this week, this tends to be the topic that's the most difficult for students, especially if you have no accounting or finance background or interest in business. The numbers, and even if you do, the numbers aren't what makes this industry great. The numbers have to be there to have the industry, but it's not what typically draws people to the industry. And so it just always tends to be a little bit of a challenge. And I had the privilege of listening to Dave do a similar presentation a couple of different times to some trade organizations of adults who are in this industry. And he broke it down so nicely and made it make so much sense that I sort of hunted him down and begged him to see if he would come and deliver the same thing for you today. So that's what we're going to do. Dave is going to explain to us kind of the nuts and bolts and basics of what it takes to make money in seniors housing. Because remember, our namesake Granger Cobb said, no margin, no mission. So with that, Dave, it's all you.
Thank you. It's great to be here. I would have absolutely loved to come onto your campus. I've been there a couple of times and really enjoy it. The reason I left for a second is I have something here. This is Trudy and Nancy. A long time ago, I in each of the companies I've run, I try to bring the elephant into the room, and so I literally bring the elephant into the room. And Trudy's a really nice, fluffy one. And what I usually do, if I was there in person, I would bring Trudy and I would say, listen, there's no question you can't ask. You just need enough courage to do that. And if you need to give Trudy a little squeeze, then you do that. But the only way we ever really get our questions answered in the first place is by ask them. And so sometimes you have to bring the elephant in the room in business when things aren't going right, things aren't feeling right. The only way for leaders to ever really understand that is to have somebody speak up without fear of reprisal. So that's why we always have elephants with us when we manage. I'm going to see if I can share here my first test and whether or not I can actually accomplish this. Let's see if I got this right.
You did it.
Yeah, except that where is this thing? Now I got to find it. All right, hold on a second here. There we go. Okay. Can everybody see this all right?
Yep.
Okay. Well, look, the business of senior housing is absolutely a business, and I will cover a few things today. First of all, I'm going to talk about who am I and why should you even listen to me, and so we'll go over that a little bit. It is a little bit different background that I come from in the industry, but then Nancy, honestly, I never met 5 or 6-year-old that said, when I grow up, I really want to be in senior housing. So everybody comes from somewhere, and it's usually somewhere else except for senior housing. So we do have that going for us. I'm also going to talk a little bit about what does the business of senior living even look like. I'll go over the P&L, and so you can see what the P&L has in it, the income statement. Also, what does investing in senior housing look like? We're an operator, and you may have heard from other operators, Aegis or Merrill Gardens or others. Operators simply mean we manage the business, and we usually manage it for other people, and other people are the ones that own the business. And oftentimes, what we're managing, we don't own. And I can tell you who does own those communities. Sometimes managers like Aegis owns all or most of or much of the buildings that they manage. We only own or have an investment in maybe a third of the buildings that we manage. So there's a lot of, and there's other companies that have no investment whatsoever in the buildings that they manage. So management companies, operators are all over the place. But I'll show you what it looks like if you're an owner and you're investing in senior housing. I'm also going to show you that if you want to buy or sell a community, how would you determine how much that community is even worth? So I'm going to explain that to you, and this is very real. We do this all the time. This is how we come up with valuing a business like senior housing, but this methodology can really be used for valuing any business. I'm also going to talk a little bit about what the impact of the interest rate movements have had in the last few years on our industry. For those of you that are in school and don't yet have mortgages, interest rates may not impact you much, but I will tell you this, whether it's your household budget or whether it's a business, like anything in the real estate business, interest rate moves like the moves we've seen in the last 5 years have been dramatic and very impactful. And I'm going to show you why and what they impacted and how you even calculate what the impact was. And then we're also going to talk a little bit about what technology can bring to our industry. I think it was last week, Nancy, you heard from Safely You. Is that right? I've known George for a very long time. And I can tell you the first time I met George, I told him he's going to have a very hard time making it in this business. And I challenged him many years ago and still do. And we're very good friends. And we happily, I will say, he changed my mind, and we use their products in every building that I can. So we're very good friends. So from there, let's talk about, who am I and who in the world is Cogir? We don't even say that word in the United States. I had never even heard of Cogir about 6 years ago. Cogir is a Montreal-based organization, and I ran into him at a conference. Never in a million years did I ever think I would actually be working with them, but I didn't know who they were. But rather than putting a conventional resume up here, I thought I would show you, this is my life kind of screen here. This is me over here. I usually pick a picture of many years ago because I think we all do that. I was born and raised in Seattle. But then right before high school, my family told me we were moving to Las Vegas. And I was like, what do you mean we're moving to Las Vegas? Where is Las Vegas? That was my first question. So I went to high school in Las Vegas. And when you're in Las Vegas, you typically, when you find a summer job, it's usually at a hotel. So I was working room service at Caesar's Palace, believe it or not, back in the 70s when Sammy Davis Jr. and Frank Sinatra were still playing Caesar's Palace. I was working room service back then, and so I grew up very quickly in that job. I went to UNLV for one semester while I was in high school, but I always was intending on coming back to the Washington area. But after I graduated, I graduated with a degree in business and an accounting degree, and I went to work for KPMG. Sadly, before they were even called KPMG, because again, I'm 95 years old. I know I don't look it in the picture, but they were called Pete Marwick Mitchell at the time. They had a Big 8 accounting firm is what they were called. Now I don't know how many it is, but they've merged a few times. When I got out of school, after KPMG, I was there about 3 years. I went to work in Seattle for a hotel developer and manager, and I was there for 20 years. We built 3 Hyatts in Seattle. We had a Hilton, a Renaissance, a Holiday Inn, Crowne Plaza, lots of different brands in downtown Seattle. even though we were a very small organization. It was owned by one individual in Seattle. And one of the first things he said to me was, hey, I'm invested in all these other little businesses because people come to me and they want me to invest in things. And so I invest here and there, but I never pay attention to these investments. So will you please pay attention to these investments for me? So I thought that was going to be a little side job. I actually went there as controller. At the time, one of the first things I got introduced to at the time was a company called Coinstar, which if you haven't heard of that, they're in the grocery stores. So you put your change in there and you can change it into money at the grocery stores. And they were trying to build 20 machines, and I turned them down the first time. And then after that, made the investment and ultimately was with them as a board of director. I chaired the audit committee for 12 years during the time, Nancy, that they created the Sarbanes-Oxley Act. So I was an audit committee chair for 12 years of a public company. Midway through that, Enron and all this stuff blew up, and Sarbanes-Oxley was born, and audit committees had all these responsibilities they never had before. So I was in a unique position to understand that, and I was in my mid-30s at the time, chairing an audit committee of a public company, dealing with that. So that was a whole education unto itself. Along the way, I also got pitched of a little company at the time called F5 Networks, which today is a behemoth of an organization. That was a wonderful experience. While at Coinstar, we always tried to figure out what else we could do in the grocery stores. And somehow the grocery stores decided they wanted to get into the DVD rental business. For what reason, they didn't even know. They were trying to figure out what else to do in the front of the store other than sell firewood and dog food. And they thought it was brilliant to rent DVDs, and they were losing so much money. They asked us if we could ever figure out how to put this thing into a kiosk like we did Coinstar. And we said, let me get back to you. So we went around shopping feverishly, and we found a little company called Redbox inside McDonald's, of all places. McDonald's had a venture capital group, and they had created Chipotle, they had created Boston Markets, and they created Redbox inside McDonald's venture group in Chicago. We bought the company, we rolled out Redbox, we put Blockbuster out of business, essentially. And ultimately, Netflix, which was in the DVD by mail business at the time, did probably a quicker pivot to digital because we were really dominating DVD at the time. So we probably impacted Netflix's ultimate business path as well. So all of that became more active. And honestly, at the hotel company, I began spending probably more time on the venture side than the hotel side. And this is just how life goes sometimes. You know, you pivot and things go zigzag and you zigzag with them. And ultimately, I was on the board of another company called CNET, which is a board game that made basically the DVD player into a game console. So my pathway to senior housing was in a very bizarre a place, but what it did is it gave me these views, like these companies have nothing in common, but they do have something in common. You always have to please your customer. You have to figure out how to make money. You have to learn how to grow a business. And pretty soon, you know, the business acumen that it took for all these different organizations, you began to realize you could take that and you could take it from industry to industry and from company to company. So my background was very, very varied throughout that process, and not because I planned it that way. It just happened that way. Over here, the pinball machine and pool table. My dad was ran pinball machines and pool tables when I was a kid, and I used to do inventory and reconcile the bank statements when I was 7 years old. I know that sounds kind of stupid, but I was learning accounting, and I didn't even realize it at a very young age at that time. So my interest in business came early, and it came. And so how I got into senior housing is a little bit bizarre, but I just basically got a phone call one day from Dwayne Clark at Aegis, and they were wanting to build new buildings and develop. They were managing quite well, but they wanted to build new buildings and develop. And since we did a lot of that in the hotel business, I went and joined Aegis back in 2009, and that's when I started in the hotel industry or the senior housing industry. I'm a Seahawk fan and a Mariner fan, so it's a big week for me. I'm coming up. I'm going to try to figure out how to get to those Mariner games this weekend. So I'll be in Seattle. I'm not a Husky. I want to put that out there. Very important. I know it's very important. I'm not a Husky, so please know that. I went to the University of Nevada, Reno, actually, because, I went to high school in Nevada, and all of a sudden I couldn't get back into the universities in Washington because at the time I'm an out-of-stater. So I ended up at University of Nevada, and I really enjoyed it, and I love to play golf. So that's my resume in picture format, and my story. Doesn't mean you have to listen to me. It just means that's my story. In senior housing, I've been there 16 years. I started at Aegis. I was the CFO. I think you've heard from Adam Clark now and again. Adam and I used to work together. He was actually an analyst for me when I first started at Aegis. So we know each other well. Went over to Merrill Gardens. I ran Merrill Gardens for a while, 5 years, and then came over to Cogir. And I'll tell you a little bit about Cogir a little bit later. And I'm also the chairman of the California Assisted Living Association, which is probably the largest assisted living association in the country. So that's me and how I got here. So who are we? Who is Cogir? Cogir is a Montreal-based family-owned organization. They have 20,000 employees. They manage 51,000 units of senior housing, which is gigantic, especially for a company you'd never heard of. They have managed 23,000 apartment buildings. They have 4 million square feet of commercial property they manage. They have 3 hotels. They have restaurants, all kinds of stuff in Canada. And again, I had never heard of them. What happened in 2019, they bought 12 buildings in the U.S. 6 of them were in Washington, 6 of them were in California, and they were partners with a company by the name of Welltower. Welltower today is the largest owner of senior housing in the world. And at Merrill, we were running a 10 community Welltower portfolio, so I knew who Welltower was, and I went to a dinner and I met the CEO of Cogir, and I actually thought his accent was kind of funny because he had this French accent, and so I was kidding with him the whole time, just having fun talking to the guy. He was a really, really fun guy. And again, his first entry into the U.S., and I just gave him my card. I said, listen, if you have any questions, give me a call. And I kept getting questions from him. So we ended up forming a friendship. And at the time, there was 12 buildings. There was about 1,250 units of senior housing. They were actually former Merrill Gardens buildings. So that was sort of interesting. But we kept in touch, and what he wanted to do really was just grow the operation across the border into the U.S. and just keep on growing. And really no more plan than that, other than the growing was going to be by a lot of development, new building development. That was the plan. He wanted to spend $1 billion building new buildings in the U.S. That was the plan. I was retiring, frankly, from senior housing at the end of 2020. I told him I really didn't want to help. I didn't really want to go to work doing that. That sounded like a lot of work, very ambitious. So I went on his board and I said, I'll work 2 days a week and I won't even be an employee. You just pay me a board fee and that'll be fine. 3 months later, we got into the pandemic. So everything changed. They couldn't build in the U.S. anymore. And so we pivoted back to pivoting, right? We pivoted right away. And ultimately, we grew the business a different way, and I got more involved, and now I have the largest job of my life. And so my retirement, I had a retirement party. It was great, but it lasted like 3 months. So another pivot, right? So today, at the time, we had 12 buildings in the U.S. We had 55 buildings in Canada, senior housing buildings. Today, we have 110 communities in the U.S. with over 12,000 residents. We have 200 communities in Canada. We're the second largest non-public operator in North America. And we're the largest operator for Welltower, who's the largest owner of senior housing in the world. All of that in 5 years. Didn't see any of that coming. And we got here how we got here. So you don't always need to make a plan. You can make a plan. It doesn't mean it's going to be that plan. So that's who Cogir is, and that's how we got here. Our vision really is to be the best in class U.S. senior living solution and management company of choice for employees and industry investor group and ownership groups. So that's our goal, not growth, not large, just best. However we grow, if we grow and we're starting to not be the best, then we will stop growing. We have three really core pedestals that we sit on. Number one is human focus, meaning we have to be good to work with. We have to be good to each other. I don't know if you have any golf fans in the room there, but the Ryder Cup was this weekend, and Tommy Fleetwood is a great player for Europe, and he's a great player. And he basically said his father raised him to be a good person first. Golf will come, winning will come, but just be a good person first. And we look at that in our business as being great human beings first and foremost in everything we do. We also have to be creative. The pathway of how we got here, my personal pathway, the pathway we got to where we are, we have to be creative. You always have to be creative. I mean, look at what businesses have to deal with today with tariffs and technology and politics and interest rates and everything that you have to deal with. You know, you have to be creative in how to navigate through those things and come out the other side. Never, ever be comfortable. And comfortable will sort of be a little bit of a death knell, being complacent in business. So we're always creative, and we seek excellence in whatever we do, financially, resident-centric, great employer. Everything we do, we try to be excellent at it. And so those are really the foundation, the three foundation pedestals that we sit our company on. Here's where we are. Up here on the left side, again, is where we started. 6 buildings down in here in California, 6 buildings up in Washington State in 2020. And here's where we are now 5 years later. Those 12,000 units, we probably have to have 7,000 or 8,000 employees to service 12,000 residents. So anytime anybody ever calls this industry a real estate industry, I remind them of the fact that it takes 7,000 employees to take care of 12,000 people. It'd be like calling Nordstrom a real estate play just because they happen to own their stores. Nobody has ever accused Nordstrom of being a real estate company. And this is very much an operating business, despite the fact that it somehow finds itself in the real estate sector alongside office and hotel and other things. It is, make no mistake about it, an operating business. And I would say, 70% of our costs in some way, shape, or form relate to labor and labor management. So that's the complexity of our business. And this is geographically where we are. We're still growing, but that's where we are. Here's where we kind of stack up. This is always a moving target. Even this is old already. It's the 2025 top 10 operators. We're there in the 10 slot, showing us with 10,000 units. We now have 12,000 units. So it's hard to keep this current. This comes out once a year. That's where we are. And so we'll talk a little bit about who owns these communities in the United States. Different kinds of people own them. There's a company called Brookdale. Brookdale owns every building they manage. They're what we would call an owner-operator. They're a publicly traded company. You can follow them if you're interested in the industry because they're public. You can see their financials, and they don't manage anything they don't own. That's an owner-operator. There's real estate investment trusts. And Nancy, I'll tell you the story one day. REITs were invented in Tacoma by a guy named Blake Eagle. I'll tell you that story one day, so you know where REITs ever came from. But REITs are basically owning real estate in a way that you can invest in it in a public way, just like investing in stock like Coca-Cola. You don't have to own an apartment building. You can just buy some shares of REITs, and REITs come in all forms and sizes: hotel REITs, apartment REITs, office REITs. There's senior housing REITs, and 3 of them here. Welltower is the largest, and there's a company called American Healthcare and NHI. There's a few other REITs that are publicly traded. Some REITs are privately traded, and they own lots and lots. That's probably the predominant owner of senior housing in the U.S. Private equity funds, The only difference between the two is a REIT is public, the private equity is private. So if Washington State University Endowment Fund, for example, wanted to make an investment, they might do that through a private equity fund like Harrison Street and PGIM and Starwood. They get large investors and they have funds that are specifically targeted for senior housing. And then you just have individuals or family offices that are trying to diversify their portfolio and bring some senior housing into their investment grid. So those are the owners today. Aegis, for example, is an owner-operator. That's an example of an owner-operator as well. What do they have in common? Well, they all expect to earn a reasonable rate of return on their investment based upon whatever their standard is. And they all have a little different standards. If you're a family office and you just want to keep somebody's money safe and earn, 5, 6, 7, 8%, that's your standard. A publicly traded REIT might have a standard that looks more toward 18 or 20% annual returns. So each of these owners has their own investment target and threshold and standards that they define for themselves. And then they differ. Some use debt, some do not. Welltower, for example, uses cash. They have access to capital because they're a publicly traded company. They don't use debt. Other organizations will use debt. Different return targets: 5, 7, 8%, 10, 11, 13%, 20%, different return targets. The time horizon. REITs, for example, sometimes can own these buildings forever. They don't care. A pension might own a building forever. They don't care as long as it keeps producing cash flow. But like a private equity fund, they may have a fund. The investors might say to their investors, you're going to invest, you're going to hold for 5 or 7 years, then we're going to get you out of that one. And so they'll have to turn those things in 5 or 7 years. So if we're managing a community for a fund, we know they just bought something, they want us to manage it. I can guarantee in 5 or 7 years, they're going to say, hey, we're going to sell the building, in which case we may or may not manage that building. It depends on who buys it, right, after that. So there's a time horizon difference for holding the assets. There's a size difference. Not everybody's Welltower size. Some REITs are very small. Some investments organizations like family offices are very small. So some own fewer than 10 buildings. Some own hundreds. There's an owner-operator versus a pure management company. ISL, for example, Integral Senior Living, is a pure management company. I don't believe they own anything, and they just manage. Versus, say, Aegis or others that are just they only manage what they own. And then there's an appetite for acuity. Acuity meaning care. Some only invest in memory care, for example, or skilled nursing. Others really don't like the idea of licensed communities, and they invest only in, say, over 55 or independent buildings. So different investment theses for different kinds of ownership groups. And that's how they differ. So but before we start talking about how the business works, I think it's really important that we just learn some key terms that are used in our industry. And I will tell you this, these key terms are not known, actually, by everybody in our industry. They should be. I have done, I don't know, Nancy, I couldn't even tell you how many interviews I've done. The executive director is the boss. So if you walk into a senior housing community and you ask to speak to the CEO of that building, it's going to be called the executive director. I have interviewed countless numbers of executive directors, and there are many things we're going to cover today they don't know. So your class today will learn things that many executive directors don't know. They're afraid to ask. They don't have this. If they had this, they could have asked a long time ago. But and this, Nancy, is why when you talk about some of these conferences I've spoken at, I get people coming up to me and saying, look, in 20 years, I never knew this stuff. I've been in this business for 20 years. Nobody ever told me this. I don't know why they didn't tell me this. I don't know why they didn't tell them this either. But I think it's really important. So I want you all just to understand, if you're interested in this business, I can make it simple. I think it's a complicated business, but everything doesn't have to be complicated. We can try to make simple the things we can make simple. So we'll start there. I put green when it's coming in, it's money, right? Red is bad, green is good. And I needed something other than green for profit, so I made it blue, right? So green, incoming, the cash is coming in the door. That's what we're going to call revenue. So in your accounting classes and anything Nancy's going to throw out you financially, any of your other classes, you're going to hear about revenue or income, income. That's why I use the word incoming. Coming in the door. Our primary revenue sources are from rent and from care. We do dining, but we don't charge for food. Food is included in rent. Think of it like an all-inclusive resort. Sometimes you go to a hotel and they're all-inclusive resorts. You don't have to pay for the food, like a cruise is an all-inclusive resort. And but an independent living building isn't necessarily, and neither is a hotel. You pay for the food. Here, food is included in our rent, but we do charge for care. At our company, we charge separately. The rent for a unit is this much. If you need care, we charge for it thusly. Some companies do something called all-inclusive, like a resort. They'll say, you're going to pay $10,000 a month. It's going to give you everything you need. We don't do that. Some companies do, but that's the incoming. There's a few other little things, but that's the primary piece of it. Outgoing, there's lots of different things though. Staff, you can count how many times I put the word staff on that sheet. There's staff all over the place. There's different departments. There's an administrative staff, the executive director, the business office director, people that handle the administration of the community are staff. There's food, of course, and there's a dining staff. If I were to say dining department, I will tell you this, like think of a restaurant, food is about 1/3 of the cost. The staff is about 2/3. So when you're looking at the dining department, it's relatively true of a restaurant as well, although in a restaurant you have things like utilities and the cost of the building and everything else. But the whole sum of that dining department is in two places, primarily food and people that are dealing with the food, serving it or cooking it. 2/3 labor, 1/3 food. Then we have the care staff, 95% labor. I mean, we got a few rubber gloves and some other things, but fundamentally care means labor. Activities, mostly labor. Housekeeping, mostly labor. Utilities, no labor. Utilities, those are all over the place these days too, and but only going upward. Property taxes and insurance. So utilities, property taxes, and insurance are some of those things we kind of call the non-controllables. There's only so much we can do to control that. So everything except for those bottom three dots, we really have to try to control as an operator. And so that's where our expenses are going. That's the outgoing. We got to get the incoming to be more than the outgoing. Simple as that. If you ask Granger, you need a little blue in there, right? You need a profit. If you don't have a profit, what are you doing? And I will tell you, this is not the end of it. A lot of times people say, well, you guys make so much money. I mean, why are you charging me so much money? So profit simply revenue minus expenses. Now we call that net operating income, net operating income, NOI. If you ever talk to an executive director and you say the word NOI, that is an acronym they will know, NOI. We use that term for profit, operating profit, net operating income. So a lot of people think, well, that's the end of that, except here's the blue now. I'm going to put the blue on the left-hand side now, because what do we do now? We got an operating profit, then what happens? Well, remember, we don't own the building. Somebody owns that building. That building was not free. These buildings are $50, $60, $70 million. You got to pay for that somehow. Usually it's a mortgage. So you take your operations, you got your operating profit, hopefully, because now you got to pay for the pleasure of being at that address, right? So there's debt service. There's a mortgage payment. Like any other mortgage payment, there's interest and principal. And it's a big number. So if you're making $100,000 a month, chances are your mortgage payment is $50,000, $60,000, $70,000 or $80,000 a month. So you have to have NOI equal to or greater than your debt service. And there's one more thing. These buildings don't stay beautiful like this forever, right? The furniture wears out 5 or 7 years. With walkers and wheelchairs, this stuff gets banged up pretty good. Might be 5 years, might be 10 years in some buildings, 5 years in other. What? Depends on the acuity, right? So these buildings wear out, carpets wear out, furniture wears out. HVAC systems don't last forever. Roofs don't last forever. So capital expenditures are for real, okay? And so the only way you're going to pay for your mortgage and your capital expenditures is from your profit. Keep in mind, you're an investor, right? You're trying to make money here. You don't get any money until A, you make a profit, B, you can pay your mortgage, C, you can pay your CapEx. Then and only then, as long as your profit's large enough, you have net cash flow available for distribution to your investors. Also known as what's left, right? What's left? What's left after all that? It's NOI minus debt service minus CapEx. That makes sense? I mean, you run the business, you pay the mortgage, you keep the place looking good, and hopefully you still have enough money left to satisfy your investment returns. Investment returns imply a return in the first place. Now, the only business that can't operate this way that I'm aware of is pro sports. If you own the Dallas Cowboys, you can lose $200 million a year. It's just fine because the value of your investment will go up by $1 billion a year. You're okay, as long as you can service the cash flow. Everything else in life, this has to work, and that last box needs to be green, or you're in trouble. Hold that thought, because back to debt service, remember I said we're going to come back to interest rates in a minute. That debt service box, very impacted by interest rates. So we'll come back to that. But we got to keep that last box green, or we're in trouble. So, recapping, NOI is net operating income. Is simply the profit, the revenues minus the expenses. NOI margin, I'll get into that in a minute. Same thing, just as a percent of revenue. So we say NOI margins. If I say, what are your margins? You're not going to look at me funny. And I hate to tell you this, 70% of the interviews, when I ask an executive director, what were your margins like, they look right through me. They don't know what to do. They're looking for Trudy, and that means percent, 25% margins, 10% margins, 50% margins. That's what I'm looking. That's the answer I'm looking for. Some percent of profit as a percent of revenue. Debt service is our mortgage payment. CapEx is capital expenditures. And net cash flow available to distribution is really what's left for the investors every month or every year after we paid all those things. Okay? So let's look at an income statement. The Cogir of Wazoo monthly income statement, okay? And I'll give you an example. This is relatively accurate in terms of how it's put together. So if we have total revenue, for example, of $6 million, it's typically broken down between, say, rent and care. Now, if we're in a completely independent building, we won't have any care. If we were a hotel, we'd have rent and maybe, internet income or food and beverage income or catering income or something. But hotels and senior housing, not terribly different. After rent, rent is made up of room rate and occupancy, right? Room rate and occupancy. After rent in both hotels and in senior housing, there's other things we charge for. The most popular one in senior housing is care. The most popular one in hotels is probably food and beverage or other elements like that. Nancy, when I started, it was the telephone department. I know. Now I think we charge for internet and make all kinds of money that way. I don't know. Lost track of that. But that's the green stuff right there predominantly. So how much do we get down in the blue area? Well, if I go all the way to the bottom, I'm going to skip the red area for a second. Now I'm going to go to the bottom. What are my goals? What do I like to see if it's healthy? Healthy. Reasonable profit. All right. Remember, we got to pay the CapEx and the mortgage payment. So we can't come down to zero here. if I could bring 33%, call it a third. Now, I personally like to look for 40%. Sometimes you can get there and sometimes you can't. And usually that depends on what zip code you're in and the kind of rate you can charge up on the very first line. Because these costs are not all that different from one neighborhood to the next neighborhood. But as you drive around, you all drive around Washington every once in a while, you can go through some really, really nice neighborhoods and some not so great neighborhoods. But the people that work in those buildings are going to make relatively the same wage. And the utilities are going to be relatively the same. So the costs aren't that different, except maybe in the food. We're going to serve more fillets than we are in one building or another. But all the labor and all this other stuff in the red is not all that different. So the margins are typically a function of what rate we can charge. But let's say we want 33% margins. That means we got to bring $2 million of the $6 million down to the blue area, right? So now we look in the red area and we see dining, food, and labor. It's another question. Not a single person, not one person in my history has answered the question. When I ask an executive director, how much do you spend per month for every resident for the dining program? They start spitting out food numbers. I didn't ask that. I mean, everything, labor, everything. How much do you spend? $500, $600, $700, $1,000? What's the number? Because we give the dining away in the rent. So think about a all-inclusive resort. They got to know how much they're going to spend on food and beverage for each person they bring into that resort, because that's a pure cost. Before they decide how much to charge per day, they better know this number. 20% of our revenue is kind of a threshold for me. So if you think about 10% being 400,000, look at the rent, 4 million. If we spend 10% of the rent, that's 400 grand. If we spend 20% of the rent, that's 800 grand. Anything more than 20% is going to be hard, because that's really going to eat into this 33% down at the bottom. So if we're charging $10,000 a month in Beverly Hills, we can spend more on dining than if we're charging, $3,000 a month in Tuscaloosa, Alabama. We just can't spend the same amount on the dining program. So it depends. It depends on how much we're charging. So I like to see this as no more than 20% of revenue. So in this example I put out there, I just stuck it right at 20%. That's $800,000. Our care costs, I like a care margin. I don't like to, first of all, people are there to get great care, right? I mean, it's not a dirty word to say we have to charge for that. They expect us to charge for it, and they expect us to do a great job. I simply expect a reasonable margin on that. So if I look at $2 million of care, how much would it be appropriate for a profit there? Okay. So if I have 1.2 million, that means I have $800,000 of profit in the care department. I don't like running the care department at a loss. That doesn't make any sense to me. If we're going to do that, we might as well just have an independent building, right? Why would we pay for the privilege of taking, all this effort for care and taking risk and licensing and everything else? So our dining and our care costs are very, very much having to be managed. And that's $2 million of costs right there out of our total $4 million of expenses. So that's very labor intensive, very staff oriented. That's where probably 80% of our employees live, in either the care department or the dining department. So if you want to manage labor, you got to manage these two departments. If you manage these two departments properly from a labor standpoint, you're probably managing labor fine. So I don't have to get on somebody when they say, how much overtime or how much outside labor are you using and blah, blah, blah. If they've got these two departments relatively in order, I don't have to ask those questions. That's too far in the weeds now. Whatever you're doing, financially at least, it's working. I don't like a lot of overtime because we wear people out, But fundamentally, this is where we have to really manage ourselves. The rest of the labor, housekeeping and activities and admin. Then you have property taxes, insurance, and utilities, and they're down below the relative non-controllables. So this is what a income statement will look like fundamentally. So if we have $6 million of revenue and we end up with $4 million of expenses, we'll end up with $2 million of profit. That's a 33% margin. And so that's what a basic income statement will look like. And that's our NOI is 2 million, and our NOI margin is 33%. It's simply $2 million divided by the revenue. The top line, the bottom line divided by the top line. A third, 33%. Make sense? All right, so how do investors approach an investment? This, by the way, is what senior housing looks like. You've probably seen some pictures from other presentations. They are beautiful these days. Usually when people walk through the front door, they go, wow, I just had no idea it was going to look like this. This looks amazing. And I don't know why I was dreading this for so long. I mean, I think of a nursing home with shiny floors and one flew over the cuckoo's nest or something, that's what people have feared for years. But with design and with great companies building great communities, they look beautiful inside. They look more like high-end condo buildings. So this is what the new generation of senior housing looks like, okay? Now, how do you know how much to pay? And you can build or you can buy senior housing. So as I said, when we were starting in the United States, we had the idea of building a lot of communities. But things got expensive, interest rates went up, costs went up during the pandemic. And so that really came to a screeching halt. And I'll talk a little bit about that a little bit later. But when you invest in senior housing, you buy or build it, you hold it for a certain period of time. You have to fund the losses or receive cash flow during the time period that you own it. Either Dallas Cowboys, where you feed it, or Granger Cobb buildings, where you receive cash flow during the time period you own it. And then ultimately you sell the community. And then you ultimately at that point, you realize a reasonable return versus the risk that you're looking for. So from an owner's standpoint, red is outgoing, green is incoming. You start with red. You pay for a community, you buy it. You then have either losses, which you're feeding it, or cash that you're getting distributed from profits, one or the other, during the time period that you own it. If you have to invest in CapEx, which you always do, that goes out the door, and then ultimately you sell it, and that comes in the door. And that's the basics of what it takes when you own a senior housing building. You have a transaction profit, hopefully, when you're done with all that. And when you're done with all that and you say, how much was my annual rate of return while I held it? You're looking for something in the double digits, most likely. That's what most of the investors are looking for when you add all that up. Now, an operator, as a manager, a lot of times our job is to get the NOI, get the net operating income to be what we need it to be. Then the owner, he takes out a mortgage, he buys the building, he takes out a mortgage, he has to take what we give him in NOI and make his mortgage payment and then invest in renovations in the building or something. So a lot of times our operator, from an operator's perspective, our world ends in NOI, okay? But remember the monthly cash flow of Cogir of Wazoo, that's that $2 million. But there's this other stuff down below. The cash flow to the investors is less than that because they have to pay the mortgage and they have to pay the CapEx. So the question is, what is a reasonable return and how would you get there? So let's start with how you value a building. And there's one more term I'm going to teach you. Again, not anybody in the industry that operates typically knows it. It's called a cap rate or a capitalization rate. And simply put, a cap rate is how much you would expect to earn on an investment. You're going to make an investment. What kind of return are you looking for? Okay. Any investment is based on risk versus reward, okay? And there's higher risks and there's lower risks in the investment world. Now, what's safer? Putting your money into a savings account in a bank or buying a senior housing community? Now, most people would think putting your money in a savings account is safer. Okay, well, let's look at what savings accounts pay. Now, back in 2020, when I started this venture with Cogir, you basically got nothing. Interest rates were so low that if you put your money in a CD or a savings account, it was literally 0.1%. And it was like that for years. In 2021, because of the pandemic, and we started getting massive inflation from all of these things that were spinning off the pandemic and whatever else you want to blame inflation on, the Fed had to start raising rates to try to put that fire out. And that's the basic tool the Fed has when we get overinflated, is to make money more expensive, to slow things down. So they began raising rates, and they did it in a very rapid way. Look at that move from 2020 to 2022. And that's in savings accounts rates. We went from 0.1% to 5% in 2 years. Now in 2025, we're back down a little bit. We're still at about 4%. So you could take your money, your 10 million, your $100 million, stick it in the bank, and make 4%, and you're fine. You sleep good at night. So what's a fair rate of return if you want to invest in senior housing? It better be more than 4%, right? Because you can get that in the bank. In 2020, if the savings account CD gave you 0.6%, these were the returns expected from these different kinds of investments. Apartments are less risky in this group than independent living. Independent living is less risky than assisted living. Assisted living is less risky than memory. And a lot of the buildings have a blend of independent and assisted memory care. So that's kind of a range. So those are the kinds of returns that were expected back in 2020. And in the red, you see those are the cap rates that are being used in 2020. The difference between the savings account and the blend is 4.5 to 5, 6% difference between the safe investment and the senior housing investment. So you're going to try to get a premium over a savings account if you invested in senior housing. That's in 2020. Now, 2025, a savings account pays 4%. Well, okay, then how much do we need to get a return on senior housing now? Because if I'm going to get 5% return, I might as well put my money in the bank and just go play golf. It's not worth an extra 1%, maybe not even worth another 2% to take the kind of risk that it takes to get into senior housing, memory care, assisted living. So what are the cap rates then now? Well, it's tough to say. 7 or 8%, maybe. And that's what has changed. Cap rates in 2020, 6%. Cap rates now 7 or 8%. Not unheard of. Let's talk about what that means. How do we put that into a valuation? So let's talk about how you value a building. Let's break this down real simple now. Each month, each unit, we're going to charge $6,000 for rent. It's going to cost us $4,000 to operate the unit. We're going to have a $2,000 NOI for every unit of senior housing we own, okay? 12 months in a year, that makes $24,000 a year. If we have a 100-unit building, basic 100-unit building, we have NOI of $2.4 million in our 100-unit building for a year. Now, how much would we pay for that building? Well, if we want to earn 6%, if you write a check for $40 million and you multiply that by 6%, you would earn $2.4 million. So you write a check for $40 million, you buy that building, it gives you $2.4 million back. There's your 6% return. You're getting a 6% return on your investment. Okay? So the cap rate of 6% is what we had in 2020. So in 2020, it would be logical that this building would sell for roughly $40 million. Okay. Then what happened? If interest rates go up like they did, and now we need 8% because 6% doesn't cut it anymore when I can get 4% in the bank. So now that cap rates are 8%, how much should I pay for that building to get the same 2.4 million, same building, I'm earning $2.4 million in that building. At a 6 cap, that's a $40 million building. But if I write a check for $30 million and I get 8%, I get $2.4 million. So that building is now only worth $30 million. That's a 25% reduction in the value of that building. Okay? 25% value destruction because interest rates went up. So the person that bought that building for $40 million in 2020 is not happy. Because remember the 5-year hold, that fund bought it, now they got to sell it, or they got to refinance their loan. And that loan, if it's on a variable interest rate, remember the mortgage payment? We used to pay X, now we pay a lot bigger than X. We went from making money, cash flow available for distribution to investors, to no cash flow available for distribution to investors. In fact, the owner to put money in every month to make the mortgage payment. And that is what we've been through over the last 5 years, where you have mortgages that are coming due, having to be refinanced, or buildings that are now being sold. And they're being sold for less than they were purchased for 5 years ago or built for 5 years ago because of this. That's the impact. 25% decrease in value for 2 interest rate point moves or cap rate point moves over the last few years. So what do we have to get the NOI back up to preserve our 40 million? Well, more. We need $3.2 million because see, now you write a check for $40 million times 8%, that's $3.2 million. We got to get the NOI up from $2.4 million to $3.2 million just to keep the same $40 million value, okay? And so you're either going to take a loss on this building or you're going to beat on the operator more. And so that's the pressure we're feeling. More. 2.4 million was always good enough. Not anymore. You know, I need more from you. I need more from you. I need more from you. And so that's the dynamic that's been happening between owners, their banks, owners and their operators. And that's the tension that's happened over these last few years. So you can have an understanding of that. Okay. So if I tell my team all the time, I mean, if you can find $100 a month more in profit per unit, that's 100% margin, by the way, because you just charge $100 more. By the time you sift it all the way through the math, how much more profit that gives you in a building, and then you use a 6% cap rate, you can increase the value of that building by $2 million by just getting $100 a month more in rent. And that's why it's so important to be this granular when it comes to managing rate and managing our communities today, because that interest rate move has been extremely impactful and has driven a lot of anxiety and pressure in the industry. And there's some other things going the right way, and I'll get to that in a minute, and I'll be mindful of our time too here, Nancy. So I'm going to move forward a little bit. The state of the market today is development's very stalled because it's very expensive to build, and sometimes you can buy it less than building cost. Okay, and that's been a lot of that's been happening. What that's going to lead to is a lack of supply coming into the market. That's not a bad thing if you're an operator. So you look at this thing here. You've probably seen this graph before. How many people are going to reach the over 75-year population over this time period? Here we are, right about in here. We're right here, okay? All these people are going to have a place to live, okay? And that's the population growth. The aging baby boomer generation will likely generate an average annual demand for about 40,000 new units annually over the next 10 years because of this aging situation. Right here, no new buildings are being built, nothing, because interest rates are high, costs are high, and when we can buy things for less than building costs, why would we build? That's going to create a lot of not new openings, okay? Here are the new starts. Here's the inventory of growth through 2024. This is what 31,000 units looks like. Remember I said 40,000 new units per year are needed? Look where we are in terms of new building growth. Nothing. nothing being started in 2024. It takes 2 years to get a building built. That means nothing new opening in 2026 or 2027. So we're going to have this big gap in new supply. That's good if you're an operator. It gives us the ability to get all our buildings full. And when our buildings are full, our rates can come up a little bit. It gives us the opportunity to keep up with the rising labor costs and overcome them so we can hold our margins, deal with these higher interest rates until interest rates come down a little bit. And so the supply demand in our industry is really, really good for us for the next few years and enables us to get through the interest rates and get through any supply issues that we might have. So we have to improve margins if we're going to pay for that higher debt service. We have to improve margins if we're going to deal with these higher labor costs. And the good news is we're able to because of this supply demand curve. AI, as George probably explained to you, is giving us a lot more information about when people fall or they might fall, or even tracking how much more care we're giving to our residents. Because if the staff are being able to be tracked through some AI tools that George's company is making, we can tell that a particular resident is getting more visits from our staff. And if that's happening, something is telling us we probably should be charging more because we're caring for that person more. So there's a lot of stuff that's going to help us on the staffing side coming out of AI and variance analysis and tools. They're going to be able to have us understand and manage our business better. Data science. I'm a nut when it comes to numbers. I want to see everything. If this was your business, you'd want to know every little wrinkle that was going on in this business. And with data and data mining and data science and AI tools that enable us to look at variances and variables, when 70% of your costs are in labor, there's a lot of AI and data analytics you can apply to labor analysis that will be very helpful between AI and different tools like Power BI and other things that are coming along in the data world. So that's the business of the business, the best I can give it to you. And I will stop there. And we have a few minutes left, I guess, Nancy, and not a lot. But if anybody has any questions, I'm happy to entertain a question or two.
Well, Dave, first of all, thank you.
If I needed it.
I go back to my opening comment about yours being the best explanation of how you make a buck in this industry. I'm sorry, my voice is scratchy. You do the best job of making the numbers make sense. So thank you for that. And I hope the students, we have some accounting and finance majors in there, and I'm going to guess you were sort of talking their language a bit and was probably very helpful. Darcy, I'm going to let you, because I can't see super well, maybe monitor or watch for questions or comments from the students.
Lilia?
How do you how do you emphasize your staff's happiness? I know you said that was a major part.
Could you repeat that? It's just hard for me to hear.
How do you emphasize staff happiness and retention? Because I know you said as part of being the best, you want to take care of your staff. How does that happen?
How do we retain staff? Is that what you're asking me?
And keep up the staff happiness, because that's one of their core values.
Yeah, well, here's the thing. First of all, we try to hire staff that want to be there. This is a very wonderful industry. I mean, you are bringing smiles to people's face every day. And, aging, elderly people are wonderful, wonderful. It's a wonderful environment. We try to keep it that way. Think about when you go to work at a place and there's just a lot of tension, a lot of negativity, like how long would you work there? Imagine if your customers live in your stores, how long would they live there? If the place was like full of anxiety and stress all the time, our residents just won't live there anymore. They won't want to. So it's really important that we provide a happy place for our residents. We try to pay what we can, but it's more than that. We try to acknowledge people when they do a great job. We, pay pay is one thing, but I think the important thing is how we treat our staff with dignity. We try to be as flexible as we can. We try to help them when they have problems. We really try to take care of the best that we have and make sure that they're comfortable. And we listen. We try to listen very carefully. How do you feel about working here? What can we do better to make you enjoy the atmosphere more? Because the more you enjoy it, the more our residents will enjoy that. We have some staff that have worked here a very, very, very long time, and we just really try to take our lead from them. It's really important that we have a happy resident population and a happy staff, because without that, we're just never going to get anywhere. If you're not pleasing your customer, you're on a downhill slide from the get-go.
Hey, Dave, do you have a cost related to that? I know some companies have like a certain percentage or a certain dollar amount associated with what it costs for retention, like when you have to rehire at a certain position.
Well, it's a high number and it's hard to calculate. Back to our ratios. We have resident, not resident, we have employee funds and budget for all of our communities to be able to do, I don't care what it is, bring in food trucks, have monthly drawings, whatever you want to do, have happy stuff going on for our employees. And if they don't spend that budget, they get in a little bit of trouble. I don't want them saving that money. If they overspend that, then we usually ask, what'd you do? I mean, was it fun? Like, what did you have in mind? Tell us more about that, because it must have been worth, having to be questioned about why you overspent that. I think we really want to make sure we do a lot of that. And then all those costs are built into those budgets. So again, I don't care how much they spend on keeping our employees happy, as long as it fits into those same ratios. These ratios are for people in accounting. I have a 15-year-old. He says, he comes home from school. I say, hey, what'd you do in school? He says, well, we did a bunch of stuff I'm never really going to use in real life. I used to think that about things like analytical review and KPI tools and things, these ratios we learn in the accounting class. I'm like, when am I ever going to use these things? We have reams and reams of analytical review things. And we look at when you're not spending enough on your employees, when you are spending enough, what's the right spot? So there's a lot of KPI and analytical review work that we do that, yes, you will use this stuff in real life.
Anybody else? Nancy, do you have anything? Oh, there's one. Aisha? Oh, Ben Alexander says hi. He's mentored one of our groups, and Aisha wanted to make sure you knew he said something about you.
Very good. Hi, Ben. Well, it's fun to talk to you all, and I love your interest in the business. And I can tell you this: not all businesses are alike. Nobody was, like I said, at 5 years old screaming to go into senior housing. If you want to go into something that really makes you feel good every day and you're making people happy, also think about this. There's not a lot of businesses where the supply demand curve is always going to be in check. We know the demand. Like even a pandemic couldn't change that chart. So we know, I don't know if you're selling Apple Watches, if you're selling tickets to baseball games, every kind of industry around has a hard time figuring out what's the demand, what's the supply, are these things going to match up for the next 10, 20 years? We know our demand, so the business model is understood, it can be calculated, and now the supply side is in our favor. So we have a business and an industry that's healthy, very, very healthy right now. And so as you look to graduate and say, what am I going to do? A lot of things are changing with AI and a lot of things are changing. There's always uncertainty. The one thing I can tell you is certain for a while is this industry is extremely healthy. And if you want to go into a stable industry and you want to have a position that makes you feel like you're really doing something from a humanity standpoint that makes sense, people taking care of people, this is a pretty good industry for that. And there's plenty of economics, there's plenty of technology, there's plenty of financial metrics or non-financial things for you to have an interest in. So Nancy, I applaud you for bringing this kind of thing to the lives of students. It's very difficult and to find universities around the country that even broach the subject. So I applaud you for that.
Well, thank you. I wish it was my idea, but it was the industry that came to me. So thank y'all for making that big move. Dave,
I remember
this has been,
Granger.
Yep.
I had lots of good conversations. He was a wonderful person. So not a
Yeah.
lot of us still around that knew him, but anyway, he'd be proud.
Dave, thank you so much. Students, thanks to Dave.
Very, very welcome.